All right, so I seen this post from Morgan Housel, and I thought I had to make a video about it. So let's get right into it here. The same people, 2010, don't buy stocks. They won't go up. 2024, don't buy stocks. They've gone up too much. And he also goes on to say, long-term buy and hold is imperfect, subject to long stretches of low/negative returns, but it's also better than anything else for 99% of investors. And first things first here, if you get value out of this video, please like and subscribe, comment, all that good stuff. I really appreciate that. Getting right into it here, I think that this is a very good way to put it. And another good thing, or another important point here, rather, I was listening to a podcast yesterday, an investing podcast from 2020. I believe it was April of 2020 or March of 2020, and I think everybody knows what was going on then. They were in the midst of a very large and fast drawdown, and one of the things that the guy said is, oh, well, you know, the stock market still arguably is overvalued, especially the large cap tech areas. And if you would have bought the NASDAQ in March or April of 2020, you'd be up probably double, probably even triple by now, right? So you would have made absolutely fabulous returns. So the point there is not necessarily to wait for a big dip and then you buy. The point is almost every point in time, there's going to be an argument as to why you shouldn't buy stocks. Like, there's almost never a time. If you were to read Wall Street Journal or one of those publications, whether you take a quarter or a half a year or a full year, there's probably never been a point in time to where there isn't someone saying, hey, you shouldn't buy stocks for this reason. When stocks are down 20 or 30%, they're going to be down 50. Why are you buying now? Hell, even when they're down 50, it's going to go to zero. You're going to lose everything. The smartest people, and this is just kind of a life thing here too, is that something I notice about smart people that are achieving more than other people, for lack of a better way of putting it, is they're better than other people at making calculated decisions, in that they understand odds and probability, and they can just think clearer. Everything in life, I mean, pretty much every decision you make, to some degree, you consider odds and probability. Am I going to benefit more or not from doing this? And stocks is a great comparison of this. If you look at stocks, like 75% of years, the market is up. So if you were to just randomly buy at the start of every year, it's overwhelmingly likely you're going to be up. If you were to take any given point in time and go a year in the future, I guarantee you that the numbers are probably somewhat similar too. You're almost certainly up. So an important caveat here is, I think it depends if you're an individual stock investor or if you're an index investor. If you are a pure index investor, I don't think that there's even a close second strategy to dollar cost averaging. Like, I really don't. Dollar cost averaging, by far the best strategy if you are a index investor, which is exactly what I do with the index fund, the index portion of my portfolio, probably 10-20%. I just buy a certain amount no matter what. There isn't one index I've stopped buying. I've changed around the amounts. Like, I'm not buying as much NASDAQ as I'd like to, or the growth side. I'm buying more of the value side, some of the smaller and the mid caps, and a little bit more on the international side. But when you're looking at stocks, individual stocks, it's completely irrelevant where the stock market is at. The stock market could go down 30% tomorrow, and that shouldn't play into whether or not you should buy an individual stock. And the reason being is that whether or not an individual stock is a good company or not isn't completely irrelevant as to whether the stock market is up or down. Whether a company is a good company or not, it's irrelevant where rates are at. Rates could be at 25 basis points or 10%. It's still irrelevant. So that's a very important thing to understand. And so when it comes to individual stocks, the only thing that matters, I mean, there's two broad things that matter. Number one, is it a good company? And number two, is it a good valuation? because it could be a good company but not a good valuation. You're paying way too much. The chances of you getting good returns goes down, because the higher the valuation, the lower the chances that you're going to get a better return. And this is something that's very hard for people to understand, is that lower stock prices means a higher chance of returns in the future, because the higher stock prices are, the more you're going to have to discount them, and the more you're going to have to discount them, the less chance you get of better returns. So I think this can be summed up quite easily in that the best strategy if you're an index investor is you simply just buy a certain amount no matter what. But assuming the caveat that you are actually a long-term investor, because a lot of people aren't, and a lot of people who say they aren't. So if you're planning on buying and holding for more than, let's say, 10 years, that's probably the rule of thumb that most people would give. Obviously, do your own due diligence. I'm no expert. If that's your holding pattern, you just buy $100 a month, $500 a month, whatever your number is, and you set it and forget it. And nowadays, it's actually incredibly easy, because a lot of brokerages, you can simply set it to come directly out of your bank account. I mean, you could set it, never log into your account for 10 years or 20 years, and be fine. And you could set it to reinvest dividends. You'd be completely fine. You wouldn't have to do anything. In fact, for probably 50% of the population, that is the best strategy. And there isn't even close. If you can manage the emotions of the ups and downs, and then maybe you can tinker around with it a little bit. But for most people, the best strategy is simply set it and forget it. And I mean that literally. Set it and forget it. Delete the app on your phone or your computer or whatever. I mean, obviously save the login and stuff, but that's probably the best way of going about it. If you're a stock investor, this changes a lot, because, like I mentioned, wherever the market at is irrelevant, because you're worried about where the individual stock is at, not where the market is at. Just because the market's at an all-time high doesn't mean you shouldn't buy an individual stock, and just because it's at a 10-year low doesn't necessarily mean you should buy the stock. So that is important. But the most important thing when it comes to investing is not the coming up with the perfect strategy or finding the best companies. The hardest thing is having the discipline and managing the emotions when things are way down. And when things are way down, it's definitely harder than when things are way up. But it's definitely hard when things are up too, because you're constantly worried about, our stock's going to crash tomorrow. And when stocks are down, it's like, oh, well, stocks are way down. They could go down way further. Why would I buy? That's the hardest part. And that's why the set it and forget it strategy is so good, in that it might not be the one that gets you the best returns, but it's going to be the one that will if you're truly setting it and forgetting it, because some people say they're going to do that and they don't. But if you're truly doing that, it takes the emotions out of things. It takes the emotions completely out of things. And emotions oftentimes are what kill investors the most. That's like I mentioned, it's not necessarily being the best stock picker. I think people would agree that, take a Warren Buffett. He's good. Don't get me wrong, he's good. And I don't think anyone's saying he's bad necessarily, but I don't think anyone would be like, hey, Warren Buffett's the greatest picker of all time. What people, I think that the debate is that he has the best ability to manage his emotions, and he has the longest time horizon. He's been investing since he was before he a teenager, I think it was. And he's in his 90s. And I think he's been running Berkshire for over 50 years, 60 years, something like that. And nothing really has changed. Nothing really has changed. So that is the key. That is the key. And the last thing I want to touch on here too is Bitcoin, even though it's kind of different, but Bitcoin as well. Why do people not get into Bitcoin? It's the classic, oh, it's too volatile, it's too this or it's too that. But you look at the returns, and I think that's where things are at. And not only that, you look at the diversification, the ability to actually truly your bank account is not necessarily yours. It can be taken. Your stocks It can be taken. Bitcoin is that lifeboat to where you own it and no one can take it from you. Like, no one can take it from you. And that's another important thing when it comes to the psychological aspect of it. The psychological aspect of it is the biggest, and that's what keeps people from getting into it, is that the most common reason the most common reason for the average Joe is that they don't understand it. I mean, they don't understand the stock market. They don't understand the bond market. They don't understand anything. Bitcoin, like, what makes you think they're going to understand that? But when it comes to the institutional people, they have this fixed mindset of constantly comparing it to the existing system. Oh, well, Bitcoin doesn't have a yield, or it doesn't have earnings. And it's like, I understand what you're saying, but you're either deliberately misleading people when you say stuff like that, or you're just not that smart. Like, you're not that smart, because Bitcoin was never designed for that purpose. So that would be like me saying, well, you shouldn't buy a rental property because you can't go on your stock exchange and sell your rental property tomorrow. Therefore, it's a bad investment. Like, that's not the point of a rental property. Just like it's not the point of Bitcoin to have a yield or to have earnings. Right? So that's another important thing too when you're comparing things, is the ability to steel man things. And this is another example of a trait that very high achievers and high quality people have, is that they're very good at that kind of stuff. They're very good at understanding both sides of something and actually considering it reasonably. So one thing that I would say when it comes to life or even investing is you got to get really good at that. If you want to achieve anything good, anything really impressive, you got to get really good at that. You got to get really good at considering both sides legitimately, because a lot of people say they do that and they don't. And frankly, a lot of people say that and they're just straight up lying. Like, they're just straight up lying. I mean, look at politics. I won't get into politics, but that's a good example of it, right? People say, "Oh yeah, I've considered both sides," but it's like, no, you're just blindly labeling the other side as fascist or whatever garbage people say, and that's important. So, and it doesn't benefit you in any way, shape, or form to not consider both sides. Like, if I had an opinion on the best flavor of ice cream, but I've only ever tried one flavor of ice cream, would any rational person take me seriously? Like, absolutely not. So that the same thing goes for stocks, the same thing goes for everything. And this is something that whenever you hear the perpetual doomers, the stock market's always going to collapse, they never acknowledge the bull case. Not never, but they usually don't acknowledge the bull case. They have reasons for why it could collapse. I mean, yeah, there's plenty of reasons as to why. I mean, I've briefly gone over them before, but there's plenty of reasons as to why the market could collapse 20, 30, 40%. Yeah, that's not out of the realm of possibility. It wouldn't shock me. It would be surprising, but it wouldn't shock me. I mean, 20% corrections happen, like every 2 or 3 years? 30% every 5, 10 years? Like, yeah, it could happen. But is it likely? And no. Getting back to the main point here, smart people take the probability and go from there. Now, again, you could twist my words and say, "Oh, well, yeah, let's gamble all your money in the stock market," and you could be wrong, 25% of the time. It's not what I'm saying. What I'm saying is that if you have a 75% chance of being right about something, and you're going to do it 10, 20, 30 times, you would be an absolute idiot to not have your money on one side of that trade. If you're going to do it once or twice, yeah, I could see that. But that's a different story. So anyway, I think I've made my point here clear. The last thing I wanted to bring up too here is I think Morgan Housel puts out a lot of good stuff. Definitely a good follow on Twitter if you don't follow him. He does have a good book, The Psychology of Investing. I have his other one on my list to read. I haven't read it yet. I've read The Psychology of Investing probably 2 or 3 times, maybe 4 times even. It's a great book. It's a very easy read too. Like, you could be a newbie and still take home a lot from it. So basically that's what I wanted to talk about today. If you get value out of this video, like I mentioned, please like, subscribe, comment, all that good stuff, and stay tuned for more.